It's no secret that the government's disinvestment record so far has been quite patchy. After setting aggressive divestment targets for the past 3 years and missing them by a huge margin, the government had set a relatively lower target of Rs 50,000 crore for fiscal year 23. In one of our DITMs, we had spoken about how we believe that the centre may still meet its fiscal year 23 target if it successfully closes the Hindustan Zinc divestment deal. However, the centre has now decided to postpone the sale of its residual stake in Hindustan Zinc beyond the current fiscal. Now, this is on the back of the fall in investor sentiment after Hindustan Zinc proposed to acquire Vedanta Group's global zinc assets in a $2.98 billion related party cash deal. This cautioned the government over valuation concerns. In the February budget, the central government marked down the divestment target to 50,000 crore from 65,000 crore budgeted initially. Now, it has managed to raise about 31,100 crores so far. Now, with the Hindustan Zinc sale not going through this year, the government will likely not meet its target for this fiscal. So, how will this development impact government's finances this fiscal year? Meeting fiscal year 23 targets would set the tone for coming years and hence remains important. But given the lackluster performance in recent year, divestment is not being seen as a major contributor in reducing fiscal deficit. According to data, the proceeds from divestment have only accounted for 5 to 6% of the total deficit over a 10-year span. So even if the revised divestment amount is not realized, the government will likely meet the fiscal deficit target of 6.4% of GDP for fiscal year 23 on the back of strong revenue receipts. Moreover, higher dividends by CPSEs could also act as a buffer for the government if it falls short of meeting the target. In the months of November and December, retail inflation came below RBI's upper tolerance limit of 6%. After easing in the last 2 months of 2022, the CPI retail inflation for India hit a 3-month high of 6.52% in Jan 2023. In the recently released inflation data for February, retail inflation stood high at 6.4% year over year. Now, the Feb inflation print is 10 BPS lower than the January 2023 level, but it is still higher than the RBI's upper limit of 6%. When we look at the breakup, price pressures continue to remain fairly broad-based. Food inflation continued to be the main driver, but the strengthening of price pressures in non-food categories such as housing, clothing, services, health kept core inflation elevated at 6.3%. While the extremely high inflation readings that dominated the first half of 2022 are moderating, Feb inflation remained above the central bank's upper tolerance limit of 6% for a second consecutive month. Now, core CPI, which excludes the more volatile food and fuel prices, also continues to be a pain point. Now, going forward, the impact of commodity prices trending lower, the lag effect of monetary tightening, and high base effect could ease inflation. So, what does these news mean for you? Meeting the divestment target definitely sets the tone for coming years, but any slippage does not affect the fiscal math in the current fiscal. Now, this will have an indirect neutral impact on you. The overall increases in price has caused a shrinkage in disposable income, which is impacting the purchasing power of individuals. Also, RBI might remain cautious given the core and headline inflation still remains elevated. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.